California's new Dream for All down payment assistance program is looking to give you up to 20% down in order to help you buy your first home. The catch, of course, is this program uses something brand new called shared appreciation, which means the state is going to take a share of your appreciation when you sell your home. And if you're watching this video, you probably have a ton of questions on whether or not this program is going to be right for you. Lucky for you, I got my hands on the lender guidebook early. And so in this video, you're going to learn exactly what the guidelines for this program are. And I'm going to answer some of the key questions that people have had about this program and show you some specific examples on how I think you should use this program to take advantage of it this year. Now, if you're new here, my name's Keaton. I'm a loan officer from San Diego, California, and on this channel, I help people just like you learn how to buy their first home and make the mortgage process a lot easier. Now, before we get started, if you're thinking about buying a home in California or you're planning on using this program, I've left a link in the description below to schedule a one-on-one call with me to figure out whether or not this program is even going to be a good fit for you. But with that out of the way, let's get into the details of this brand new Dream for All program. Now, for starters, if you haven't watched my previous video covering exactly how the shared appreciation works, I've left a link to it right here, so make sure you check that out if you have questions. But to make it very simple, the state is basically going to have a one-to-one share of whatever percentage that they lent you in your appreciation. So for an example, if you use the maximum 20% benefit, the state would take the original amount they lent you plus 20% of your home's appreciation. I've heard a lot of misinformation that the state is going to take 20% of your future purchase price, which is absolutely not true. They're taking the original amount they lent you plus 20% of the appreciation. So essentially whatever you've paid towards principal is going to continue to be yours. Another big misconception about this program is that the state is going to own 20% of your property, which is absolutely not the case. The state is just going to be taking a second lien position, and they're going to have a repayment clause built into that in order to take the appreciation after a few trigger events. But at the end of the day, you will still be the title holder, not the state, not anyone else. Now, with that out of the way, let's jump into the guidelines. For starters, this program is going to be available only to first-time homebuyers per the federal definition. As a refresher, that means anyone who has not owned or been on title to a property in the last 3 consecutive years. So even if you've purchased a home and owned one in the past, as long as you haven't owned a home or been on title in the last 3 years, technically, by definition, you are a first-time homebuyer once again. Now, that also means that everybody who's on the loan has to be a first-time homebuyer. And on top of that, you have to be buying this home as your primary residence. So this can't be used for things like second homes or investment homes. It has to be used as a primary, which also means that non-occupant co-borrowers will not be allowed. Anyone who is on the loan must be a first-time homebuyer and must also be living in the home as their primary residence. Another small detail that they've added in is you have 60 days after the purchase of the home to actually occupy it as your primary residence. So for example, if you're writing contracts and you want to give the seller up to a 60-day rent back in order to make it a little bit sweeter, you can do that. Now, on top of the first-time homebuyer requirement, CalHFA is requiring you take not just one, but 2 different courses in order to qualify. The first one is a pretty quick and easy course that just covers what shared appreciation is, so you have a better understanding of how that's going to work for you in the future. The second one is a little bit bigger. CalHFA is going to be requiring you to take a timed online 8-hour course that's cost $99 to get you educated on first-time home buying. Now, that's a pretty hefty course, and of course it comes with a fee, so they're really wanting to make sure that you're serious about first-time home buying and that you're really educated, which I'm honestly a big fan of. But by the end of this video, you're going to be a master on both of those topics anyways, so it'll be a breeze. Now, some things that we already knew about the program coming in were there going to be income limits based on your county. As a refresher, go ahead and pause. These are the income limits based on your county in California. What's great about these income limits is they're a lot higher than Fannie Mae's usual ones, so it makes this program a little bit more accessible to a lot more people. Another thing that we knew going into this program was there's going to be a FICO score limit of 680 and a DTI restriction of 45%, which honestly is pretty in line with most down payment assistance programs anywhere. But now they've added an additional tier if your credit is 700 and above. If your credit score is 700 or higher, that DTI limit jumps up from 45% to 50%. And you better believe that extra 5% of buying power is going to be a big deal to a lot of people. Additionally, we already knew that at most the loan amount was going to be based on the conforming limit of 726,200. But now we know that high balance is going to be an option as well for those who live in high cost of living areas. Now, if you are going to be borrowing above that conforming limit, you are going to be paying a fee. Now, the amount of that fee varies from time to time, but you can expect it to be around 1.7% of the loan amount. So for example, if you were buying a home in, say, Los Angeles, where the high balance loan limit is over $1 million, you could be looking to be spending as much as $17,000 to $18,000 in order to use that high balance benefit. Now, something interesting to note that they've added into this is that 20% can be allocated not just towards your down payment, but towards closing costs as well. That's a really big deal because essentially you could do something like 15% towards your down payment, the other 5% for your closing costs, essentially coming zero out of pocket. Of course, that would entail having mortgage insurance, but that's up to you. That being said, if you do decide to go down that route and put less less than 20% down, CalHFA's mortgage insurance premiums are actually lower than if you weren't using this kind of program. You might even have the option to buy out mortgage insurance entirely and not have mortgage insurance, even if you're only putting 15% down and using the rest towards closing costs. Now, another thing that they've added regarding shared appreciation, if your income is above 80% of Fannie Mae's area median income, the share is going to be on a 1-to-1 ratio. So if you borrow 20% from the state will share in 20% of the appreciation. Now, if you're under 80% of your area's median income, that ratio drops to 0.75 to 1. So instead, if you borrowed 20% from the state, you would only owe back 15% when you went to sell. Now, not a lot of people are talking about this, but it's really only because there's not that many people who fall under that 80% AMI who are even going to be qualifying to buy a home, even with the maximum benefit from this program. But for the few of you who will, you guys are going to be getting an even bigger benefit from this loan. Additionally, the minimum loan to value for this program is going to be 70%. So this means you could essentially use 20% of the state's funds and kick in an additional 10% of your own funds in order to increase your purchasing power. Lastly, this program is only going to be available for property types that fall under single family homes, condominiums, or manufactured homes. So unfortunately, that basically rules out anyone using it for a 2 to 4plex or any other kind of multifamily unit. All right, now that we've got the guidelines out of the way, let's actually cover some of the biggest questions that I've been asked pretty much all week about this program. For starters, the biggest one is what actually triggers the repayment of the shared appreciation? Does it really only happen when you sell the home, or what else can trigger that? Well, according to CalHFA themselves, repayment of the principal and any share of the shared appreciation loan can be repaid under these following events. So this includes transfer of title, sale of the property, payoff of the first loan, payoff of the subordinate loan principal balance, refinance of the first loan with some exclusions, and the formal filing and recording of a notice of default. It's also worth noting that neither of these two loans are assumable. So some really interesting points to point out there. For starters, we already knew that the shared appreciation would be due when you sell your home. But that left a lot of questions for people who were planning on, giving this home eventually down to their kids later on down the road. So it clearly states now that if you are transferring title to somebody else, that would trigger the repayment of the shared appreciation loans. That also means if you were to transfer the title into something like a business or a trust, that also would be a triggering event. Now, something we already knew, of course, is that paying off the first loan would be a trigger event. That includes taking the loan to term, so the full 30 years. So for example, if you were to stay in the home, take it the full 30 years without ever having a refinance done, that would actually trigger the shared appreciation loans to be paid, as well as the original principal balance. But there's two things here that I was actually pretty surprised to see. The first one is an early payoff of the subordinate loan. Now, I didn't think you could do this, but apparently if you wanted to, you could make payments on the subordinate loan as well and pay that balance off slowly but surely. Now, why anyone would want to do this, I don't really know, because you're not forced to make any payments on it for the life of the loan, and it's at 0% interest. There's really no big benefit there. And if you do end up paying the thing off early, that would trigger the repayment clause as well for at least the shared appreciation portion. But the bigger thing that I'm surprised to see that everyone had a question on is the fact that you can refinance this loan with some exceptions. Initially, I thought that if you were to refinance this loan, that would be under that first category, right? Paying off your first mortgage. That would trigger the shared appreciation, which would eliminate the benefit for most people to refinance in the first place. The reason why is you would essentially have to consolidate your first mortgage plus the second one plus the shared appreciation, which means your payment would essentially skyrocket. But now this guideline is basically telling us that, hey, CalHFA is going to let you one time and one time only do a refinance and not have to pay back that shared appreciation loan plus the shared appreciation. And for me, that took this program from being a good down payment assistance program to being the best one I've ever seen. It was the biggest question on everyone's mind because let's be honest, rates aren't particularly great. And if there was an opportunity to save money, you should be able to do that. But now you're going to have to really decide when you want to refinance. The question for a lot of people will be, do I refinance when it hits 5%? Do I wait for them to get into the 4s? Because ultimately you're going to have one shot at this. So you might as well make that refinance worth it. Now, another big question that I've been asked pretty much all week is, can you pair this with any other kind of loan, like, for example, a NACA loan or a VA loan or a USDA loan? Unfortunately, this is only going to be paired with a CalHFA conventional mortgage. Now, given the amount down that you're getting from this program, if you're using some of these other 100% financing programs, this one's going to be making a lot more sense for you when it comes to the payment specifically. Now, of course, everyone's finances are different. For example, if you've got the VA loan benefit and you already qualify for that anyways, it might make more sense for you to use a VA loan. A big reason why is is the VA loan has an unlimited amount of refinances that you can do through using the EARL program. And of course, the bigger and more obvious one is that there's no shared appreciation involved when you're using a VA loan versus this one. And that more or less goes with the FHA and USDA loans as well. Now, another big question I've been asked pretty much all week is, does this program really make that much sense putting your own money down, say for example, 5% on a conventional loan, or using this program instead? Now, for starters, if all you're looking at is the monthly payment, this program makes a million times more sense. Just looking at the numbers on a $500,000 purchase, the difference between using this program at its fullest, basically 20%, versus putting 5% of your own money down, the monthly payment difference is about $700 a month. To put that into context for buying power, that's about $140,000 extra in purchasing power. So theoretically, if payment was no issue, you can go from buying a $500,000 home to a $640,000 home for nearly the exact same monthly payment. And let's be honest, in a pricier market like California, that's going to go a long way for you. So essentially, by using this program instead of your own money down, especially if you were just putting the minimum, you're going to get not only a lower monthly payment, but you could potentially get a higher purchasing power, all for about the same amount out of pocket. Another big question that I've been asked pretty much all week is, can this be paired with some sort of interest rate buy down? And the answer is yes, technically. Well, CalHFA sets their own interest rates and there's no way of buying down that interest rate. You can pair it with something like a 2-1 buy down or a temporary buy down. So for example, if the rates on this program were starting at 6.5%, you could do a 2-1 buy down and start at a 4.5% in year 1, go to 5.5% in year 2, and end up at 6.5% in year 3. All while knowing you still have the benefit of refinancing that one time to lock in that rate whenever it gets to a level that you're comfortable with. Another thing I realized actually while I was filming this is because you can use the funds for either the down payment or the closing costs, in the event that the seller wouldn't, negotiate and get you the money that you would need for a 2-1 buy down, you could essentially just, reshuffle the funds and use it to pay for your own 2-1 buy down instead, which I think is mind blowing. Now, one of the other big questions, especially for those who are thinking about holding this property long term, is there a cap on how much that California can take back? And the answer is yes. At most, California is going to be taking 2.5 times the original amount that they lent you. For example, once again, if they lent you $100,000 to start, the maximum that they could claw back in the future is only going to be $350,000. And honestly, once again, that's a really good benefit because as we know, California home prices can go pretty high really quickly. Now, I think one of the biggest and most important questions that people are asking right now is, how soon do I have to apply for this in order to take advantage? And I would recommend basically right now when you're watching this. This program goes live on March 27th. And the state of California has only allocated about 300 and 350 million in funds for this program. To put that into context, if the average purchase price for people using this program is $800,000 and they're using the full benefit of 20%, each of them would be using $160,000 of this fund's money, which means a little under 2,200 families will be able to actually use this program before it runs out of funds. And there is no indication by the state that they plan on renewing funds every single year for this. As I mentioned in my previous video, this is going to be a self-sustaining program. So the funds will only be returning back into the pool when people start selling, transferring title, or any of those other triggering events. Which means that in reality, it could be years before we see more funds added to this program in order for you to use it. Now, I don't mean to say that to scare you or to make you feel rushed, but that just is what it is. Now, if you do want to know if the state ever actually renews funds into this program or if there's any changes coming to it, make sure you hit that subscribe button and ring that bell so you never miss a video from my channel. All in all, in my last video, I shared my thoughts on this program. I really liked it with how it was originally built up. And now with some of these really nice, essentially quality of life changes for not just home buyers, but as well as us on the lending side, I think this is a phenomenal program. And I really hope to see this being a fund that gets used for years and years and years in California. The eventual goal for this is for California to have $1 billion annual fund in order to have families use this program in perpetuity. And what's great about that is they plan on basically having it be self-sustaining. So that means taxpayer money isn't really paying for it. It's just people who are using this program paying it forward to the next family, which I love. As I mentioned, the program launches on March 27th of 2023. And if you're somebody who wants to take advantage of this program or just figure out how they can buy a home in California at all, once again, I've left a link in the description to schedule a one-on-one call with me to help you set up a game plan to use this program or any of the great programs available to you as a first-time or second-time buyer in California. And if you're just starting your home buying journey, I suggest you watch this video next that breaks down my best tips and tricks as a loan officer of 8 years, helping serve hundreds of first-time home buyers throughout California to help you figure out exactly what it is you're going to need to get pre-approved. But as always, thank you so much for watching this video. If you liked it, consider leaving that like button, hit subscribe if you want to see more just like this, leave a comment if you've got any questions, and I'll see you in this video next. Bye.